All right, today we are diving into a really fascinating puzzle in the market, clean science and technology. Now, on one hand, the stock has just been absolutely hammered, but on the other, the business itself looks fantastic on paper. So what is really going on here? Let's get into it.
And that really brings us to the main question we're trying to unpack today. Is Clean Science a fantastic company whose stock is just, temporarily out of favor? Or has the market correctly sniffed out a serious problem with the business itself?
First, let's just look at the numbers to see how bad it's been. Over the past year, while the main Nifty 50 index was actually up about 5%, Clean Science stock fell off a cliff, down a staggering 41%. I mean, that's the kind of performance that makes any investor sit up and ask some tough questions.
But here is the paradox, the big contradiction. While the stock looks totally broken, the business looks absolutely elite. We're talking about a company with an unbelievable 43% EBITDA margin, basically zero debt on its books, and it's the #1 player globally in 4 of its key products. So what gives?
Okay, so to really understand this puzzle, we first have to figure out what makes the business so special to begin with. Let's explore what I'm calling its green chemistry fortress. These are the powerful advantages that are supposed to protect it. At the very heart of its strength is this amazing 3-step cost advantage machine. It all starts with something called backward integration, which is just a fancy way of saying they make their own key ingredient, aerosol, instead of buying it. This one move lets them make their final products 30 to 40% cheaper than anyone else, which then, of course, leads directly to those incredible industry-leading profit margins. And here's what that looks like in a single powerful number: a 43% EBITDA margin. That is literally double the industry average of around 22%. This isn't just good, it's completely exceptional, and it's all thanks to their special in-house green chemistry processes.
And if that wasn't enough, the company's balance sheet is an absolute fortress. We're talking zero debt, almost 1,500 crores in cash reserves, and it's churning out about 270 crores in free cash every single year. This kind of financial muscle means they can pay for all their big expansion plans themselves, without borrowing a single rupee.
So, if the business is such a fortress, why on earth did the stock crash? Let's flip the coin and look at the red flags and the very real risks that have completely spooked the market.
Okay, the biggest red flag, the one that really got everyone worried, was a massive sale of shares by the founders. Back in August of 2025, they sold a huge 24% chunk of the entire company in one single deal. Now, anytime founders sell that much of their own company, you can bet investors are going to get nervous. So before this big sale, you can see the founders, the promoters, had a massive 75% stake in the company. They were firmly in control. But look what happened after the sale. Yes, the promoter stake dropped to 51%, but check this out. The institutional ownership nearly tripled, jumping all the way to 30%. The fact that big, smart money funds were the ones who bought all those shares, well, that's a huge vote of confidence in the underlying business. The second major headwind has been a simple slowdown in growth. After hitting a peak in fiscal year 23, sales have started to dip. In fact, the most recent quarter they reported was the company's weakest in 3 years. That's got people wondering if this is just a temporary blip or a more permanent problem. So with those risks in mind, how exactly does the company plan to get that growth engine started again? This to me is the most exciting part of the whole story, the new growth drivers that are just beginning to fire up. So the company, through its subsidiary, is launching a whole series of brand new, high-margin products. The biggest one is a chemical group called HALS. Now, they're the first and only producer of this in India, and they're targeting 700 crores in revenue just from this one product line. On top of that, they've just launched 2 other new products with another one coming soon. This isn't just a minor tweak. This is adding whole new layers of growth to the business. And you know what's most impressive about all this? How they paid for it. This entire 335 crore expansion project was funded with their own cash. No new debt was taken on. That right there just shows you the raw power of their core business. So, let's recap. We've got a fortress-like business, it's facing some temporary headwinds, but it has some powerful new growth engines just coming online. So let's look at the valuation now and see if this all adds up to an opportunity on paper. Is it possible the market is just getting this story completely wrong? Just look at the absolute swing in market sentiment here. Back at its peak in 2022, during all the hype, the stock was trading at a crazy high price-to-earnings ratio of around 100. Today, at the absolute bottom of pessimism, that ratio has collapsed to just 27.
So, here's the most important point of all. A valuation of 27 times earnings means the market is basically expecting the company to grow its profits by only 4 to 5% a year from here on out. That seems incredibly pessimistic when you remember that its actual profit growth over the last 10 years has averaged 24% per year.
This table kind of puts it all into perspective. In a worst case, or bear scenario, the potential downside from here is maybe around 21%. But in a base case, where things just get back to normal, the potential upside is 23%. And in a bull case, where these new growth products really take off, that upside could be as high as 78%. Simply put, the potential reward seems to be much bigger than the potential risk at this price.
And that leaves us with the final question, really, for you to think about. Is all this pessimism we're seeing in the stock price just a temporary storm that's hitting a very strong financial fortress? Or has the market correctly identified a permanent crack in the company's foundation? The real answer, I think, will show up when we see if those new growth engines truly deliver. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update.
And now I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might just be the subject of my next explainer. Thank you for watching, and keep your investing stress-free.